Welcome back to the channel, The Wolf of London. I hope all of you guys are well, or apes, shall I call you. Anyway, so the other day, it was realistically just literally yesterday, a user called Lauer, I'm mispronouncing it, but anyway, he had, well, not a Q&A or ask me anything, but he was on an interview on CNBC, and that was literally yesterday. I never got to watch it, so I actually want to watch it with you guys.
Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. How many times a week?
Like three, four times maybe.
I gotta pump those numbers up. Those are rookie numbers in this racket. Keep it up with me. Money comes in, the parade comes to town. Going down Broadway is a one-way street, whichever way I go.
I literally saved it and was going to watch it now. So, yeah, this is going to be my live reaction to it.
Be with us.
Thank you so much, Melissa, for having me on. It's a real treat.
Why a raw deal? What about the deal is raw?
Well, I think there's a lot about our current market structure that's overly complex. And if you ask any regulator, they will tell you that this is not the market structure you would design if you were starting from scratch. And it's something that's been layered on year after year and decade after decade. And frankly, the point that we've gotten to is one in which a lot of incumbents have been able to structure it exactly how they want it to be structured because they're making a lot of money and they are able to wield a lot of political power. And I think we've really lost sight of the two primary purposes for markets, which is price discovery and capital formation. And price discovery is so critical that happens mainly on stock exchanges, on lit markets. So this issue that you just brought up with half of all trading taking place off of exchange and 70% or more in stocks like GameStop and AMC, I think is a real problem, and it's costing everyone money. It's costing the retail investors money who are trading through their brokers and all of whom's orders are being sent to people like Citadel and Virtu, but it's costing pension plans and mutual funds money because they're the ones trading off of the exchange quote. And if that quote is wider because of all this off-exchange trading taking place, and by some estimates, 25% or more is how much wider the spread is than if all of those retail orders were to make it to the exchange. So if they're trading against a wider spread that's 25% too wide or artificially widened, that's costing pension plans money. That's costing mutual fund companies money. That's where retail truly has all of its wealth. And I think that's a big problem.
So they're getting a raw deal because they have to pay more under this current antiquated system that was built by incumbents, you say?
Yeah, that's right. And when you have the internalizers in a de facto duopoly, you have other issues around corporate concentration of power and antitrust. And Gary Gensler has said exactly that in his SEC testimony, or in his congressional testimony when he was becoming the SEC chair, and in his first testimony. You know, this is an issue that I think is going to get a lot of attention, and I think that concentration of information is also problematic, right? If 70% of GameStop is trading through Citadel and Virtu, and they're also making markets on exchange, and they're the designated market maker on the NYSE, for example, they have a huge information advantage. And that kind of information advantage means that they have a lot of power to set the price of that stock. Now, it doesn't mean that they're affirmatively manipulating it. I'm not saying that, but it does mean that they have a lot of power and they can swing it, in all sorts of ways to help improve their profitability or change the quote at which they're then internalizing.
Hey, David, it's Jeff Mills here. Quick question for you. You know, obviously the SEC regulation cycle is very long. We're shining a light here on some issues that impact retail traders. Is there anything that they can actually do today to better position themselves for the environment in which they're operating?
You're asking in terms of what should regulators be doing?
What retail traders can do right now? Like, are there any actionable insights that they can take away from this discussion other than the idea that, yes, they are disadvantaged, but is there anything they can do to better position themselves given the present circumstances?
I think so. And I think that they can take a good, long, hard look at their broker. And how does their broker handle their orders? Now, if you're a retail trader, it is very difficult to get away from a broker who is sending their orders to this duopoly of internalizers. However, when the retail broker sends their order to an internalizer, the internalizer has a certain amount of profit that they're going to make, and then they have a certain amount of money that they can rebate back to either the broker or the retail client. So if they send it back to the broker, that's payment for order flow. If they send it back to the client, that's price improvement. They get a better price on their execution. Some brokers take nearly all of it as payment for order flow. Other brokers don't take any payment for order flow. They just give it all back to their client as price improvement. So if you're a retail investor, you can say, well, I probably want to go with the broker who gives me everything in price improvement. That's going to add up over time. And it does get to another issue that I think regulators need to address, which is best execution. And are these retail investors really getting best execution if you're measuring it against an artificially widened spread? And it's okay for some brokers to take everything in payment while others are giving everything in price improvement. I can't see how those things can possibly both be best execution. But the problem is, if you ask a regulator, they will tell you, and this is a direct quote, that trying to enforce best execution is like trying to nail Jell-O to a wall. And I think that's a real problem for markets.
Yeah, I'm not a big fan of Jell-O, really never have been. But what I'll say is, it's interesting, we're drilling down on one very specific thing, but would you submit that the playing field in terms of where we were 10 years ago to where we are now in terms of the retail has never been narrower? My sense is the playing field has never been flatter than it is now, your comments notwithstanding.
Yeah, if you're going to compare to early days of Reg NMS or pre-NMS, there's no doubt that the electronification of markets has been an incredible trend for everybody, both the institutional asset managers holding money, holding the wealth of retail, as well as individual retail investors. I would never deny such a thing. But I think if you're looking to assign reasons for that, it's hard to say that the increase of off-exchange trading is helping, or it's hard to say that the practice of internalization is helping relative to something like decimalization, which dramatically brought down costs for people without all of this complexity that we've then introduced.
Last question, Dave, and that is, since you worked at Citadel and you have comments about what you call this duopoly running off-exchange trading of Virtu and Citadel, do you think that they use what they see in terms of order flow to their advantage?
That seems like a dangerous question to answer. And so I would never say, I would never accuse anybody specifically of.
I have to stop that there before I continue. He said that was a dangerous question to answer and then nervously laugh. Not happily, nervously laugh. Like, yeah, I say this, my life is at risk.
Manipulating markets or anything like that. But I think that having that kind of information is suboptimal for markets. Having that concentration of information is not where we want to be. I believe in open and free competition for order flow. And I believe if you send all of those retail orders to lit exchanges, you would compress spreads for everybody. And those retail orders would get just as good, if not better, execution because of competition, which is something that if you're in markets, you'd think you would support, just completely free and open competition.
Dave, great to speak with you. Thank you.
Thank you for having me. I appreciate it.
Dave Lauer. All right.
All right. There we go. So that's the interview Dave had on CNBC. Now, he raised some good points there. He gave really some good points. But the thing that I mainly liked he talked about was, of course, the order flow, which is kind of what we've brought up in the Congress hearing. And it's just something that hasn't really been improved. It's like what he said was correct in terms of how can two exchanges both be offering best execution price when one of them you're paying for order flow and the other one you'll get the very, very best, which is like ultra, whatever they called it, execution. But then, of course, you're probably paying commission for the trade. So how can it be the best if one of them's free but you're paying for order flow and the other one you're not paying for you're not paying for order flow but the price would be different? It just doesn't make sense. The level field is probably not even with the amount of level 2, level 3, level 5, whatever. Fuck it, they might have level 10. I'm joking, people. But you know what I mean, when it comes to data, they're getting from Bloomberg terminals and other sources that we're just not seeing that information. Plus, being Citadel, you make 33% of the orders and you're in hedge fund. You basically get the information and you know how to react to trades. You don't even need to predict, you can just react, and reacting is clearly good enough to make money. But anyway, props to Dave for his interview. Very brave guy. Not many people have the balls to go on TV and then to stay solid as he did. Props to him.